Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky. We have Scott Rudler on the line. He's the chief strategist at T3 Live and T3 Trading. Good morning to you, Scott. How's it going on this Monday morning?
It's going good. Just getting everything together. It should be a pretty interesting morning.
Very interesting day. So, were you at your computer Friday morning and watching the S&Ps fall off a cliff from the 2060 level just under 2040 and licking your chops, wishing the market was open, or did you just take the day off and reevaluate things Sunday night?
Well, what I tend to do is when I have a 3-day weekend, I don't trade futures because if I traded futures, I'd be up all night long. It's bad enough I get up at 4:45 in the morning and go to sleep at 10. If I traded futures, I'd be motivated to keep me up a little bit longer, and then I definitely wouldn't be able to sustain the constants of what we need as a trader. So anyway, I did take a few longs on Thursday because I did think there were certain setups out there that wanted it. I didn't take too much because I always say if you have a long holiday weekend with an event, you never want to take too much on either side if it's going to impact your weekend. So for me, I actually took an 8:30 spin class. I said, you know what, I can't do anything about it. I'll come at 9:20 and I have my guys watching me. I'll get the play-by-play, and I heard that, boom, obviously the number was very, very weak. At first, futures got hit, and they tried to go green, and then they got hit further, and they closed right near the 2040 lower end of the intermediate support, which is kind of cute, which is also good because that's the level that traders have that's defined to trade against. So it would be unfortunate if it was well below that because it doesn't give you a chance to salvage your longs or at least trade versus that level. But that pretty much made sense that that would be a spot that people would want to see during market hours to see how it behaved because this is the area that's been holding since earlier in March, which is a similar feel to the same support we had around 1990, in the first start of the year. So the next day or two will be interesting to see if we hold it, if we do like a regular reversal around it, like we did back in February around 1990, or do we get decisive close below where then it opens the door for a retest of that lower area with a few micro support stops on the way to measure.
What do you make of this consolidation here? I mean, you had the beat down on Friday, and then the markets were closed to Sunday, and pretty much it's just been like a really tight range, slow consolidation here around 2045, 2046. Are you pinpointing like the first 10 minutes or a number on the open, something that, because this is very important for the market. I mean, if it just takes right off out of here, gets back in the 2050 handle, then it's no big deal. On the other hand, if we come down and take out that, but right now, it doesn't feel like we're going to take out that pre-market low.
Yeah, right now it feels like it could have been worse. I came in. We'll get into some longs. I needed to have some market exposure because if it was a market-friendly number and it was just like in line, chances are we would have been up 15 handles, and then I would have been left behind and flat-footed. So I went with things that I know I can handle. I didn't go with any indices just in case something like this happened. I went with certain stocks that I liked. So this way, even if the markets don't reclaim all the early morning weakness, some stocks might be able to go green. So I think the market right now is just having an identity crisis. It doesn't know what it wants to do. It doesn't know how it wants to act. If you look at 3/6, which was March 6th, that day when the top number was hot, I think the market fell apart. That's where we lost that 2090 area. So the market obviously didn't want hot numbers because they didn't want an accelerated interest rate hike pass. And then, this time was a little weak. People don't know if it's just because of the weather or if it's because we are in a slow patch. So the market doesn't know. It doesn't really want to buy bad news like it's been buying for the past couple of years. But it probably doesn't know if it needs to fall apart on it. But then you have some contributing factors like earnings season coming up starting this week where people are a little bit worried about the strong dollar in this quarter and guidance. S&P, I guess PEs are a little bit high compared to what we should be having coming in. So there's more than just, the jobs report from Friday that's weighing in on this range. So I think until we get more clarity on whether or not this is just a soft patch and that we could continue getting better than, decent economic numbers, and then earnings aren't so bad, we're just going to probably stay in this range. And it's a big range. If we don't hold this 2040, then there's an air pocket to 2029 and then down to the 200-day, which is 1994. But like you said, if you press this area to the short side, kind of like what people did around 1990, all of a sudden it doesn't break. we could be back above in 2055 and then in the same old range. So I think you have to have plan A, B, and C today, and just keep your size down with no big bets until you get more clarity, and just try and stay on top of what's in front of you.
We're going to throw an issue at here that don't talk a lot, but it's coming out of the chat, and that's Splunk. SPLK. Nita's asking about it, and I was looking at the dailies here, and it is, it's trying to do a gap fill, fill the gap and perhaps turn around in price, just holding above support here. Any interest in this stock? And if not, what would be your take on it?
I think it looks like a lot of things. It had a big move between February and March, and you see that huge outside day on February 27th. That basically said, game over for now. And then it broke below the 8-day, and since then it's been grinding lower. Not acting horrendous, but I would say it's something worth a feeler. I don't foresee like huge momentum coming back, and you have to be in a rush. But as a trade, it was up on Thursday, and you have the low of 57.24, which is basically holding above that gap. But for it to get like exciting again and be a momentum name that we like to have above the 8 and 21-day moving average, you're talking this thing needs to get back above like 61 to 62. So I think this is like your feeler area, but it's not something you want to be more than a tier 1 because it hasn't proven that it could get upside going besides little bounces that have so far been sold.
Yeah, definitely need a catalyst. Good point. We talked to you last week about the biotechs, and I do have your IBB chart here. People, piled into this thing. We given some of it back. Now we're just kind of just hanging in here. Could you give us your take on the IBB?
I think it was the first shot across the bow to tell us that our market wasn't ready to have momentum in other sectors also. When they sold that Biogen news, sold the Regeneron news, and had the gap up Friday that closed near the lows, I was like, okay, some quick traders might have gone short there or sold there, but then the confirmed weakness came when it lost the 8-day on that chart between 353 to 355. That was your, okay, I better get out of the way because this accelerated trend was going to break. And we know bios have been trending up for multiple years. So you have an accelerated trend, you have an intermediate, you have a macro. So depending on where you live, you want to make adjustments. So when it broke there, that was momentum leaving. So if you look at a quick move down to the 50-day that bounced off, retested that 353 area and got rejected, and now we're right back down to the 50-day again. So I think for this week, it'll be interesting to see can the bios hold above, the IBBs above 333, 334. It might play with that area a little bit, give or take $1, but a decisive close below that 50-day, there's really nothing big. It's down to 320, and if you're going to see another 10, 13 points in the IBB lower, chances are 2040 doesn't hold on the SPX, and the technology gets a little bit, pressured, and I think it's something good to watch. If it holds in there, chances are we kind of hold in there too, and we're stuck in this intermediate range. But a break, it could be, a cautionary signal that we're going to go back. We're going to get some lower prices ahead of us.
Yeah, boy, I see exactly what you're talking about on this 334 level. Couple lows, 33.97, 34 even. Tried to sniff it a few times last week, 33.78. So that is a great level. Keep an eye. I have to concur on that one. Since we're talking biotech, let's talk about the big dog. I mean, I'm sure the chart is going to look similar. Biogen, BIIB, same look here. 400, just above 400 seems to be the big level on that. Give us your take on Biogen.
You just hit the nail on the head. That's it. That's all you have. You had that exhaustion gap. That got filled. Once it went below 456, all bets are off, especially after a big move. It was that was sold. And then filled the gap and then some. So you had to try and hold prior support. And, now it really has to build above this, what's it called? Like you said, the 400 level. But if it closed below, and then again, you have an air pocket down to like 386, and then you have that gap all the way down there at 372. So you never truly know where these things are going to hold. You sell them right and reduce your risk when you see the signal. You get the test area. So this is a tester area around the low 400s, and if it doesn't hold, you get out of the way again. And you just don't want to have opinions with these things because they can be punishing both ways. So I would watch the IIB for clues of the IBB, and then also I guess Celgene. Let's see what that's doing. Celgene, that was breakout failure. You never want to see that. You had the breakout that closed decent on that March 20th, and then engulfed that entire breakout on the 23rd, right there. Trapping longs and getting people who got stopped out of their shorts a little upset, and now it hasn't really found a friend since. So now I would say today, with everything lower, maybe look at 110 on Celgene. See if 110 holds. If 110 doesn't hold, and you have a name that has actual earnings in biotechs, it just shows that it's not ready. And again, that means people aren't taking momentum risk on.
Scott, how much emphasis do you put on upgrades and downgrades from Wall Street? Giving an example here, Wells Fargo upgrades Microsoft to outperform. How much emphasis do you put on those? I know you really like to stick to your own analysis and your own numbers, but what's your take on upgrades and downgrades?
It all depends where they are in the chart, and it depends on what the name is and what type of upgrade. You look at Microsoft, which has been pretty much broken this year ever since the last quarter's earnings. It's below every moving average. So down here at 40.29 near the lows, by upgrading it here, you might see some kind of bounce, but it's again to an outer performer. It's not like it's a buy or a strong buy. It's actually I like the fact that they put something on it versus a sell down here. Like where were they at 47 or 45? So at 40.29, it would bottom feeders that sold Microsoft well. Maybe you take a look here. That there might be some kind of flight to safety because of their dividend and the liquidity and this and that. But ultimately, it's below every moving average, and this upgrade doesn't look so compelling. But then on the flip side, Facebook. Okay, that's something a bit of a momentum name and gets upgrades, gets downgrades. This on Thursday was upgraded by Citi. Okay, and it started up and then closed red. After a pullback from 86 down to 82, that was a little bit, I guess, not discerning, or what's the word? It's a little bit of a cautious signal because, like, if you after a $4 or $5 pull in on not even in a down day, if you can't hold that up, you should be. That means it might need a little bit more time. So there, I interpret an upgrade differently. To the fact where it was upgraded, couldn't hold the momentum, couldn't hold the gap on a decent day. So that helped my trading plan where I was long it and I got out of some. So I am small Facebook while we're talking about it. Today's probably a decent day to look at Facebook. Futures are lower from 86 down to the 80 level. That's probably a spot to, if you have no exposure to Facebook, maybe you nibble a little bit here. If you want to be in it for earnings and you want to start maybe accumulating some options, maybe this is the time to buy some calls while it's negative so the premiums are a little lighter. So this way you have it for earnings if you want to be long earnings, because we don't like to take the stock. We like to take options. And then ultimately I think where it broke out from at 79.80, that's huge. Like that has to hold right around there. Otherwise I would get a little bit more worried about that. So into this area from like 80.50 down to 79, if you're not in Facebook and you sold strength, that could be a rebuy area or positioning some calls if you want to have call exposure for earnings.
Yeah, this one looks kind of interesting. I see Wednesday's low at 80.87, and then going back after the big run up, you had a low at 81 even. So this would be one that if you're buying it off the open here and you're not seeing it back at maybe near the close pretty quickly, you may want to exit. But it is opening into some support. So Twitter's really being a tease here at the $50 level. Got up there. It looks like it was busting through 52. Put a double top in, got a downgrade back under 50 here. You think this thing, it's just hanging in here. What do you think about Twitter at the $50 level?
I think it's worth looking at, and it's worth thinking about this go from negative to positive today. For some reason, Twitter likes to do the opposite of what the market does, and I think some are actually just a little spoiled because people don't remember that it did start the year below 40. So below 40 to 50 percentage-wise in a quarter, not a bad quarter. And besides, we recommended calls into the earnings, which was great. Then you had that red dog reversal that tested the earnings gap, which happened to be on March 11th, right around that 45.79. So up here, doing some consolidation above 48.50, 49, I think is healthy. I think traders get spoiled as far as even me. Like I want action quick. I want it to go, get up and go, buy high, sell higher. But at this point, I think the longer it does some work above this 49 area, As soon as the market turns a little bit, then you have defined resistance at 51.80 to 52, where you get a close above that, then you see, the high 50s. So for now, I think it's holding in. It's above the 8-day. Not a lot of stocks are above the 8-day moving average, especially after a percentage type move that we've seen this quarter. So if you're really tight, like I'm long Twitter, if Twitter were to close below 49, I probably would get out of it and then wait again to see if it comes back in the range. But I'm hoping that it stays in here so the momentum gets tight. So when the market decides it needs a leader, this one could provide leadership once again.
And Apple has just kind of been just a tease here since the Apple Watch was announced. It's kind of interesting because you've been in the trading range 121.63 up to, I believe, 129.16. And even if you chop that more between 122.5 and the lower 128s, what do you make of, they have the release of the Apple Watch on the 24th, and then they have the earnings following that. Couple big catalysts coming up for Apple here. You staying off in this tight trading range?
No, I actually, you look at the action on Friday, it looked as if it was tight enough and closed well that if we had a market-friendly number on Friday, it could have had a decent gap up. So I'm long Apple, and I went long on Friday, and it was, had a decent mark on it too. So I need to figure out my commitment level to it because it has been choppy where you haven't had many days in a row, and the 50-day has been support recently. So you have time between now and earnings. You need to watch the price action. So if it stays above the 50-day like today, like it would be awesome if Apple goes from red to green and hangs in there, then at some point breaks above 126.40 for a trade pre-earnings. But if all of a sudden the market doesn't want to bounce today and Apple closes below the 50-day, which happens to be around 124, I'd probably get out of it, and then I'll just revisit it, and then it's just a choppy trade, and then we can figure out what it's doing closer to earnings. So for right now, I think earnings are all like the 27th.
Yes, yep, 27th.
Multiple weeks between now and then, so it's just going to trade with the markets, and this will give us some clues. If Apple opens down 90 cents the way it is today and goes green, chances are market hangs in there. If Apple opens up down 90 cents and closes down over $2 below the 50-day, then that could tell us that overall the market's weaker, and we could see lower ends of the overall ranges in the Qs, the S&P, and then obviously Apple, which would then be lower.
Okay, are you all over this Tesla quarterly update? It's rallying an announcement of 55% increase in Q1 2015 deliveries. I see it hit 200 briefly here in the pre-market, holding the gains here up 765 at 198.65. Before we let you go, would you give us your outlook for Tesla?
Tesla was great name for us when it had momentum, when it was above the 8-day, above the 21-day. It was tight, and ever since it peaked, in August, it's been sell the rallies. Recently, Musk is doing everything he can to keep some interest there because it is an overvalued name. He's trying to show that they're still innovative, and the tweet about the product, this, that, like who puts out an update on sales over the weekend of a holiday unless they, I don't know, unless somebody's whispering in their ear that this chart's basically a little broken, but with that being said, you look at the downtrend that started back in, when the stock was above 285, you have all lower highs. So for this trend to change, it would need probably a close above 203 to 204. Okay, and if that does it, then who knows? And maybe you can start a new trend. But for now, selling strength in Tesla has been better than buying strength, which we like to be able to buy strength and then sell it higher. So that to prove itself that today holds. So today will be interesting. Does it hold the majority of today's gap? Like if it opens up $7 and closes up $9, chances are traders will say, okay, look at that gap. It's a pro gap. Shorts a trap. It could act better. Go from being at the bottom of the radar to closer to the top of the radar every day. And then obviously, if they pre-announce, hopefully they left some room for a little bit more surprise. So that'll keep the shorts on their toes.
Scott Redler, Chief Strategist at T3 Live and T3 Trading Group, giving us a great outlook on the market. Thanks a lot, Scott.
Thanks for having me, and good luck this week, guys.